So 10-year just south of 1.6. We got a record high on the transports. Let's get to Bob Pisani. Hey, Bob.
Good morning, guys. Happy Monday. Mixed open, 3-2 advancing to declining stocks, but it's the reopening stocks that are doing a little bit better this morning. So just take a look. Yields up a little bit, so banks are doing a little bit better. And we're seeing nice moves up in industrials and energy materials. There's your reopening names. Tech, as you can see here, is flattish. A lot of news over the weekend about that Microsoft email problem. If you're looking for a jump in cybersecurity, you normally would see this on that kind of announcement, but you're not today. Some of the big names are kind of flattish on the open. So Palo Alto, FireEye, Checkpoint, really not doing too much, as you can see here. Very modest moves to the upside. Part of the problem is these stocks are suffering from the same valuation concerns all the tech names are suffering from since interest rates started going up. They're not cheap. FireEye's 50 times forward earnings. Palo Alto Networks, that's another one that's probably 50, 55 times forward earnings. These stocks all got hit badly when interest rates started going up. That's been a major issue. In fact, that's the big debate on the street right now. Is there a second phase of interest rate acceleration that's going to happen? You see where we are in the markets right now. The reopening's continuing. You heard about the stimulus going through. It looks like it's going through. You heard about the vaccine. 2021 earnings are increasing. The estimates are increasing, but slower than they were in the fourth quarter, but still going up. Now the battle's over that long end of the yield curve. So we started 1.1 mid-February, started moving up very quickly in the middle of February 16th, really. 1.5. Now we're close to 1.6, essentially. And this has caused tremendous damage to high-growth tech stocks, to high cash flow expectations, because it lowers the present value of the cash flow stream those companies are throwing off. So the hit to big tech names, we noted all last week. You saw Xilinx, PayPal, AMD. These are all more than 20% off of their recent highs. And their highs were, for the most part, back in February. So in 6 weeks, we've had quite a correction in the tech space. Even Apple, the big tech leader, 17% off the highs. The debate now is what happens if we go to 2% on the 10-year. Some feel we could get another 5% to 10% leg down. It's debatable, but it certainly wouldn't generally be good. The good news is that for owners of the beaten down assets, we've had mean reversion. The cheap stuff has become the real comeback winners of the year. The losers of last year are this year's winners. So what were the big losers last year? Energy stocks and bank stocks. What's the big winners this year? Energy stocks and bank stocks. And what were the big winners last year? The NASDAQ 100, consumer staples, consumer discretionary. What are the big losers this year? NASDAQ 100, consumer staples, and consumer discretionary. So this is the classic kind of mean reversion. And if you are a Jack Bogle disciple, Jack Bogle, the founder of Vanguard, he would say, folks, this is why you stay in big index funds, because if you are very long tech stocks, you're not very happy right now. You're a good 10% off of the recent highs. But wait a minute, if you just own the S&P 500 because of the rally in the other sectors, you're only 3% off. You barely even noticed anything is moving. And even the Dow Industrial is only down 2%. And as you saw, the transports, they're actually essentially at a record high right now, as you heard from Carl. There's the argument for the ownership of the big index names. When you get mean reversion, you barely move.
Shepard Smith here. Thanks for watching CNBC on YouTube.